Tax is land, tax is wish, tax is bed in which she lays, tax is tractor, tax is mule, teach him taxes is the rule, tax is food, tax is drinks, tax him if he tries to think, tax is sodas, tax is beer, if he cries, tax his tears, put these words upon his tomb, taxes drove me to my doom, and when he's gone we won't relax, we'll still be after the inheritance tax. Hi, I'm Chinyu.
And I'm Kelsing.
And we want to talk to you about GST.
Now you may think that GST is an additional burden for Malaysian citizens, but we hope after this video you may think otherwise.
So let's go through the what, where, when, who and whys of GST.
Also known as the value-added tax, GST is a type of indirect tax that is already implemented in over 160 countries. Those in Asia include the Philippines, Thailand, Laos, Cambodia, Indonesia, Vietnam, Singapore, and of course Malaysia.
If you're a time traveler from the past, you might be wondering, I've never had to pay for GST before this. When did all of this happen? On October 25, 2013, the Prime Minister has declared the implementation of GST, and on 1st of April 2015, GST has officially commenced replacing sales tax and service tax.
Now, who exactly needs to register for GST? Firms that disclose an annual sales of more than 500,000 ringgit are mandated to register. However, some firms who are below the 500,000 ringgit annual sales bracket could also opt for a voluntary registration.
Now comes the big question. Why GST? Why do I need to pay the extra 6%? And how does it benefit us? The introduction of GST is part of government's tax reform program to enhance efficiency and effectiveness of the taxation system. It eliminates the inherent weaknesses, such as the cascading and compounding effects in the sales tax and service tax. GST is also capable of generating a more stable source of revenue to the nation because it is less susceptible to economic fluctuations.
Besides that, revenue from GST could be used for the nation development purposes, hence improving the standard of living and lowering the cost of doing business, where businesses can benefit from recovering input tax charge.
Like there are two parts in the McSavers mix and match, there are also two parts in the mechanics of GST, which includes input tax and output tax. Input tax is a GST levied on capital goods, raw materials, spare parts, services which a business consumes or uses in its operations. Input VAT is the value added to the price when you purchase goods or services liable to value-added tax.
On the other hand, output VAT is the value-added tax you calculate and charge on your own sales of goods and services if you are registered in the VAT register. Output VAT must also be calculated when you withdraw goods or services for private use from the registered business.
Moving on, GST is taxed on taxable supplies at a standard rate of 6%, assuming the supply chain has only three parties: the manufacturer, distributor, and consumer. The manufacturer of supplies of 100 ringgit will be charged a 6% GST and sold to the distributor, whom will then claim the 6% input tax. After the supplies are marked up to a 50% profit margin, the supplies are then taxed on GST and sold to the final consumer. Through this transaction, the IRB will be collecting 6 ringgit from the manufacturer, 9 ringgit from the distributor, and deducting 6 ringgit from the input tax claim. Zero-rated supplies are taxable supplies that are subject to a zero rate. In other words, goods and services sold by companies are subject to GST, but at a 0% rate. There is no output tax on supplies, but businesses may incur input tax in acquiring these supplies. Businesses are eligible to claim input tax credited and charge GST on the consumer at a zero rate, which means consumers don't have to pay a dime on GST.
On the contrary, exempt supplies are non-taxable supplies that are not subject to GST. Businesses are not eligible to claim input tax credit in acquiring these supplies and cannot charge output tax to the consumer. As an example, domestic transportation like bus, rail and taxi, education, medical services and toll highway.
To illustrate the tax effect on zero-rated supply, a lobster catch would fetch a price of 100 ringgit. Since it is a zero-rated supply, no tax effect would occur on the sales and consumption of lobsters. More lobsters for me!
To distinguish from zero-rated tax effect, here's an example of exempt-rated supply. Assuming the cost of a medical care package, including the cost of hospital meals, nursing care, medical checkups, and medicine, amounting to 100 ringgit, includes input tax of 6%. The medical provider will have to incur an input tax of 6 ringgit. Taking into account a 50% profit margin, 159 ringgit will be charged on the patient. Since the supply of medical care is an exempt supply, the medical provider could not claim the input tax incurred, where at the end, consumer does not need to bear any additional taxes.
And that will be our explanation on GST.
That is all from us, and thank you for watching. This video is presented by Group 6 production team.